Alright, today this is a video on about just overall how to read the market and how to read the charts and just get more comfortable with real life examples. So today the first topic is going to be market direction. Market direction, we're going to start off. There's uptrends, downtrends. There's going to be in a range, higher highs, higher lows, lower highs, and lower lows. So we're going to begin with an uptrend. Uptrend is this is very simple. An uptrend is very simple. An uptrend just goes up, then down, then up. And then basically it's making higher highs and higher lows, higher highs and higher lows. Let's just go and find a quick one on the market real quick. See, from here, the market's moving up and it's making higher lows and higher highs. So that's how you know it's an uptrend. So it's going up again. It's making higher highs and higher lows. So you see, a low is very simple. Is when there's a low. There's a sell and a buy. So that's a low right there. And then a high is literally just a buy and a sell right there. You can clearly see this is a low right here. So there's one low. We'll give that example. That's one low. And then now there's another low, but this low is higher than another low. So that's a higher low. And a higher high is very simple. This is another high. See, there's a high and a low compared to the last one. There's a high and a low. Very simple. That was uptrend. Downtrend is very simple. It's based off lower highs and lower lows. So lower lows and lower highs, lower lows and lower highs. Very simple. And then it just moves down basically in a short. I mean, sorry, it moves down in a down motion because it's a downtrend. And very simple in the markets. It's a downtrend just right here. Overall, you see the market is ranging, it's going down. You can clearly signify that this is a downtrend. And when you signify even more is when the market see this is the first high or high sorry. This is the first low and it goes down and makes another low right here. See that low is lower than the last low. So you see we're in a downtrend and you see this high is lower than the other high. So that's how we do lower highs. And it just keeps on continue comes down. So you just it direct to the difference of downtrend and high trend. High trend, an uptrend and downtrend. An uptrend is making higher highs and higher lows, and a downtrend is making lower lows and lower highs. Just go into the market and find a nice any examples and just mark it out and just make it really simple for you. Support and resistance. This is another topic that helps us read the market, and this is really important. This helps us more on where to find better trades. So today let's mark out some support and some resistance. So today this day started at AM and we're gonna do on Nasdaq. So AM and clearly see this is where this was New York Open right here. So we're gonna base it off New York Open start. So before that we find a high, see that's right here, London lows. London high, sorry. That's London highs right there because in London that's 7 o'clock, and in London that's the highest. It's based very in London. It starts from so 17, so that's 5 o'clock to 2 p.m. But we're gonna do it just of when it starts, and you can clearly see in London session this is the highest point, so that's gonna be a high. And then we're gonna go for Asia, the same thing. So from the start 8 a.m. to all about around just before London session, so around 5, and we can see the highest point in Asia session was here, right there. And then for this trade, because Asia session it ended right there, that's the low. And then for London, the same thing, 17 right here. That's 5 o'clock right there. It's very easy. And then here there is liquidity. You can clearly see above these two highs. You can see how the markets move down and then bounces off it and then goes again. It retests it, bounces off it. And here at 11:30, this is where we would have traded because this is when the market opens for New York. So we see liquidity. It grabs the liquidity, completely sweeps the liquidity, and now and then we have to wait until what it reacts. It clearly reacted very bearish and wanted to just bounce off it and then boom. And then for in the market, that the good targets are is this one, the London lows. You can clearly see how it bounces off, and the Asia lows, and that's basically where the day started. And you see, it just completely flushes and hits every target, and then that's why liquidity is very important in the markets. All right, another lesson is price action. Price action is about pullbacks, consolidation, and breakouts and rejections. So let's get into first consolidation. Consolidation is basically when the market, in other terms, is choppy, it has no direction, and basically like a barcode. So let's do some quick, just finding a consolidation. Consolidation is basically when the market doesn't move anywhere in a very big range. Oh, it's in this range right here. See? Consolidation is chop. It's not moving away, it's basically moving sideways. And then consolidate is basically two key lines. It just ranges between each other. Goes up and down, and stays in it. That is consolidation. And consolidation is normally in when markets have no volume, they have no direction, and that's the worst time to trade. So you don't want to trade that at all. And in consolidations, there's always a breakout though. So let's we move into the second one, breakouts. See how there's a consolidation? There's a breakout right here. And then how to signify it's a breakout when it's been ranging in this range and hasn't moved. And then you see when there's a closure of a candle, when the candle closes below that range, and then normally it's like a good sign when it's like very big candle in this wick, and it closes, it's gonna break out and flush right there, and it's gonna flush down, and then that's your trade, and that's how it breaks out. And then rejections, it's basically the same as consolidation, because yeah, right here, but they're all really, it's basically when it rejects the highs, it rejects going up. You see, this is in an uptrend, making higher highs and higher lows. And you see at this point of time, up here, it rejected from going up, and it rejected that level because it's the level right here. See, there's some highs right here. This is basically the session high. This is New York at 11:30, and that's 2 o'clock. And it basically rejects this liquidity and rejects and goes down. Look, it's basically just bounces off rejections. They're all really similar. It just rejects from going higher and going up. This is very clearly sees an uptrend. It rejects it from keep on going up, and there's no candle closure above it, so it doesn't signify it goes up, and then rejects from that level and keeps on going down. All right, today's lesson, this quick one, is volume. Volume is when if there isn't good volume, the market doesn't move, and when the market doesn't move, there's no good trades. There's not going to be any good trades. You're not going to have a good day. You shouldn't trade when there's no volume. And why volume matters is because if there's no volume, the market's not going anywhere. So let's find a quick example. So this is on the 1 hour mark, and this is gold. You see from 13, this is a Monday, because on Mondays are low volume. From 13, that's around a 1 o'clock to 9 o'clock on a Monday, because there was no news, nothing affecting. The markets, there's literally no volume. The market didn't move. See, and when there's no volume, is high volatility. So it's a lot of breakouts, a lot of everything. And you can clearly see when you go up to the next day on Tuesday after the news hits. So the 10 MT, there's nice volume. The markets are moving. then move down, then move everything. And when you just go smaller on the 5 minute, you can clearly see here there's no volume at all. But when you go here, there's volume and the markets are moving. And when there's low volume, so say you hop on a chart, right? And in the markets, the market is moving like this. You do not want to trade this at all. The market's literally there's non-existence. There's no market. There's no volume. You should never trade it. And then you see how there's two change of here to this point. No market, and then you see how the candle gets bigger, and then how it just moves. It just keeps on moving, and it's actually direction in the market. Normally Mondays have the worst volume because that's how the week starts, and normally gets good volume after news or if there's news like before that day. And Mondays have normally low volume, and any days are bank holidays. There's no volume because no one's trading. Never trade a bank holiday. And any time after, say there's been a big move in the session before, we'll just give an example here. You see how this session it looks like, yeah. So 10. It's been that's from US Open. It opens. You see how there's a massive move. Let's see how big the move is. Yeah, 1.2% move. You see how it's been one big move, and then after it consolidates. Because after big moves, the markets don't move. You see again here, the markets have. This is basically New York session right here. The markets moved, and after an Asia comes along, there's no volume. So you never want to trade that at all. Alright, building your bias. Building your bias is basically before coming into your trade. Is basically saying what you are gonna do and what you're not gonna do. So it's very simple building your bias. It's like it's very simple. I could give it. Ah, need to clean that up. Building your bias is when you come into the day, you see, oh, today it's been in an uptrend. So you never want to go against the daily bias. The daily bias, unless yeah, if you go against the daily bias and like you're basically trading against the market. And basically you just go into the trade and you see the market's bullish or bearish. We'll give an example. So today's bias from open has been we're in longs. So we're in a bullish range. And then now we can clearly see there's liquidity up here. There's liquidity up here because you see it bounced off there. And now it might go because of the liquidity, it might go for shorts. But then there's liquidity up here too because it's longs. So now there's liquidity down here and up there. And then we don't know if any news on that day, but it shouldn't. See, this is banks. This is liquidity. I grab liquidity. And then just build some bearish motion and just flush down. And then hit the liquidity. See, it hit the liquidity down here. This was previous day liquidity. That was targets right there. And you're always going to see on your bias if there's news coming or not. If there's news coming, normally you don't want to trade before news. You always want to trade 15 to 30 minutes after news. Depends on the impact. Alright, that's it for the little lessons, quick ones. And then if you guys got everything, just give a like and comment. And if you need anything more, then that's us.